How to inflation-proof your savings and investments? Let us understand the costs of inflation. Suppose you earn a return of 9% per annum on your bank deposits. Rate of inflation is 8% in the economy. A lunch that used to cost rupees 100 would cost rupees 108 at the end of the year. This means, you must earn a return of at least 8% per annum to be able to buy that lunch. Since your bank gives you a return of 9%, you are happy because even after you buy your lunch, you are left with rupees 1. Wait a minute. Is there something wrong in our assumption? Tax. Tax is levied on nominal interest rate. So we have to rework on above assumption. Suppose that you earn a return of 9% per annum on your bank deposits and tax rate is 30%, the net of tax return is 6.3%. You have to make this adjustment first, because spending on lunch will not give you any tax exemption. Now if you want to buy the lunch you can't. Because lunch costs rupees 108 and after paying your tax you have only rupees 106.30. On the other hand, even if you are not in the highest tax bracket, even then this taxation hurt. For a 20% tax bracket the real return is 7.2%, leaving a shortfall of 0.8%. For 10% tax bracket the real return is 8.1%, giving a positive return of 0.1%. For nil tax bracket the real return is 9%, giving a positive return of 1%. But the practical rate of inflation are much higher, because of additional cost attached to adjusting with inflation. Now let's look at options available to you in order to earn a real return so that you can buy a full lunch at rupees 108. Earn a higher return. This may not be possible as rates of return are market-driven. You must be cautious if someone promises a return much higher than market rate of return. It is a clear indication that your capital is under risk. Earn tax-free return. There are few conventional savings products that are safe and yet provide you tax-free returns such as Provident Fund, PPF accounts. But they are not liquid and have upper limits. Debt funds and fixed maturity plans are a good alternative to bank fixed deposits to earn tax-free returns in your hands. If you are worried about safety of mutual funds, it is as safe as the overall environment isn't well regulated by SEBI. Safety net provided on your bank fixed deposits is only rupees 1 lakh per bank under Deposit Insurance and Credit Guarantee Scheme of India. Asset allocation. With a good marriage of risk management and asset allocation strategy, you can aim to generate positive real return in the long term. Consult your financial planner so that he can devise a suitable strategy that can help you keep buying that lunch without worrying about tax and inflation.